Good afternoon. Welcome to our weekly livestock market update. I'm Brownfield anchor reporter Megan Grebner. With us is University of Missouri, Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
Happy Friday to you. I wish we were talking on better terms, but it's not a very happy Friday for the cash hog side of things.
Yeah, absolutely. We continue to have a lot of less than positive news when we look at what's been happening in terms of cash markets as well as futures markets, really for livestock products generally. If we start on the cattle side of the picture, live cattle this week were basically unchanged relative to a year ago. We have seen some strength in feeder cattle prices this week. They were steady to 5 higher this week. If we look at the August live cattle futures contract, it was up nearly $2, while the August feeder cattle contract was up 30 cents for the week. The choice box beef price was a little lower this week, but virtually unchanged. We did see some weakness in loin prices this week, affecting that choice box beef price. Saving the worst news for second here, cash hog markets continue to move lower. This week we were down $4.60 on barrel and gilt prices, while that August lean hog futures contract was down again this week, down $6, a little more than $6 for the week. You know, we've lost $18 off that contract in the last 4 weeks, so it's been a pretty tough situation. The pork cutout value also down this week, down 4 cents. We now sit at a pork cutout value of 74 cents for this week. If you just remember a short 12 months ago, we were at nearly 98 cents. So what a difference a year has made in terms of that pork cutout value. And you have to remind yourself that bellies had a lot to do with that. Belly prices now are 40 some odd percent below where we were a year ago at this time, setting at $1.10. We would have been back a year ago talking about some $2 plus belly prices. It sure would be helpful if we could have seen that this year, but has certainly been tough on hog markets.
Scott, as we talk about that cash hog market, it really has been on a downward spiral. Is there anybody that's seeing profitability at this point? Are processing margins holding, or are they still trying to gain some traction there?
Well, I don't think very many folks are going to claim they have any black ink going at this point in time. I do worry even for the rest of the year, though. It's hard to see that turning around. Processors, on the other hand, I think have been able to hold some reasonable margins. When you look at what's been happening there, we frankly are in a situation where they know there's big runs of hogs and cattle coming in front of us, and they don't have to get too excited about purchasing hogs or cattle, knowing there's a lot coming, I think, for the remainder of this year.
Makes their job fairly easy for what they need to do.
Yeah, absolutely. And I remind us, you know, there's both sides of that. There are periods of times when we were short animals. It was certainly tough on the processing side of the industry, but given the kinds of expansion we've seen in both cattle and hogs over the last couple of years, their job gets easier, I think, in terms of buying live animals.
Scott, as we talk about the cash hog market specifically, do producers need to brace themselves for the last half of the year?
I worry there's a lot more downside weakness coming. I mean, if you think about where we sit today, and we know we don't have the largest hog runs under our belt for 2018, I think it continues to put pressure on prices unless something big happens on the other side, and that's kind of on the demand front, I guess. But for right now, it seems like to me that just the overall supply increase continues to drive the information that we see in terms of what's been driving markets. When you think about the fact that pork production for this year continues to run 4 to a little more than 4% above a year ago levels, and is running 12% above where we were 2012 to 2016, that by itself tells you a lot about what's going on in the marketplace on the pork side.
I'm going to jump around a little bit. Typically, we go into some of the other reports and we end up with a jobs report. But I want to look ahead to that because you bring up the demand picture. But we also talk about, we take a look at those numbers, specifically that unemployment rate. Does that make us a little concerned too? Because do we have enough workers to keep that expansion at capacity and keep animals moving through like they need to?
Well, so we're certainly going to be a lot tighter in terms of that slack capacity, if you will, as we go in the latter part of 2018, given that I think some of these plants are going to have a very tough time with enough labor to really truly talk about double shifted plants. And you look in some of the places, and I'll take Iowa, for example. I think unemployment rates there even are lower than what we might see for the national average. So it's even a tighter situation, and just taking workers from one pork processing plant and enticing them to another doesn't help us overall in the hog industry. And I think we've seen some of that going on as well. So it's not clear that we couldn't have some shackle space issues here late in 2018. We would have thought 12 months ago that wasn't going to be an issue at all, just given the capacity. But now, given that second shift in some of these plants is going to be pretty hard to get on board here, we could be a lot tighter than otherwise is the case. And all I say is that puts more pressure on hog prices here later in 2018.
Does it also make it challenging to maybe outsource or bring in some of that labor from temporary workers or foreign workers, especially with some of the conversations that's been going on around immigration and those types of things as well?
I think when you look at where we are right now, it certainly does make it difficult to bring in any kind of temporary labor to help you there. Who knows what we get out of immigration reform, if anything, here in the very near term. But we're just not going to see a lot of slack in terms of employable folks to work in the processing side of the industry. And I'm not certain that changes anytime soon.
It's a pretty quiet week, or it's been a pretty quiet week report-wise. We're going to delve into land values a little bit here first as we take a look at that. Any surprises really as we look at USDA's estimates for both cropland and pasture values?
So probably not a lot of surprise. So we did get strength out of those numbers released by USDA. If you look at overall pasture values, for example, 3% higher this year relative to a year ago. Might be a little bit surprising just given where cattle prices have gone of late. Cropland values in the United States up 1% out of the report. So we got strength on both sides, maybe slowing down a little bit in terms of the growth that we've been seeing in those values. Cash rental rates higher on the cropland side slightly relative to a year ago, while pasture cash rents stayed constant according to USDA this year relative to a year ago. So again, a little bit of slowing, and it's not slowing in terms of the increase that we see. Not surprising when you realize it wasn't that many years ago. We had U.S. farm income that was in excess of $120 billion, and now we're looking in the $60 to $65 billion range for this year. That we're slowing down that increase in values of pasture and cropland.
On the pasture side of things, how does that fit into cattle producers and some of the farmers and ranchers that utilize that pasture land into their budgets as well?
Yeah, so it really creates another squeeze for them. And if you're in a situation where, and some of our producers here in Missouri are in this situation now, very dry weather, not a lot of hay available. The hay that's available is pretty expensive at this point. All of a sudden, if you want to go try to find some new acres and those pasture rental rates have moved higher, all of that really just makes the bottom line that much harder, and probably in many ways continues to add to the list of reasons why we'll be done expanding the beef cow herd when we see those January 2019 counts.
We're going to talk demand the rest of the way out. Restaurant Performance Index was released this week. Talk to me a little bit about those numbers.
Yeah, so thanks for getting us to the positive side here for a little bit. The overall Restaurant Performance Index for June came in at 101.6. So strength in that index continues to be seen, and we're up from a 101.2 that we registered in May. Current Situation Index came in at 101.9. I point that out only because we had some really strong same-store sales out of that June data that we got on the Restaurant Performance Index. So to me, that's helpful. It's just not expectations guiding the growth in that overall Restaurant Performance Index, but really same-store sales that helped drive us this month. So some good news in terms of domestic demand growth. Thank goodness that we continue to see that, just given everything else going on in these markets.
You get a little positive demand talk before we get into that whole trade conversation, because that's not necessarily on that same positive level. But something else that is good, more jobs added this month, and the unemployment rate, while we talked about maybe some concerns with it, overall is good news for domestic demand.
Yeah, absolutely. So we added 157,000 jobs according to the data that we got out this morning. Maybe a little less than folks thought pre-report there in terms of new jobs created. However, I think they went back and revised previous month jobs report even a little higher. So we are seeing growth in more jobs. Unemployment rate did slide back down to 3.9% from the 4.0, so very near 18-year lows in both job numbers as well as that unemployment rate. If you look at wages were up 2.7% year over year. Inflation's probably running somewhere close to 2%. So we're getting a little bit of growth in that real buying power, but I'm sure folks would like to see more as we look at the wage side of that equation.
But overall, as we see those numbers hold steady or improve even slightly, that's good news for our consumption here domestically, typically.
Yeah, and Megan, I wouldn't want to think about where we might be today had we not seen the strong domestic demand picture that we've seen here in 2018. What's already a pretty tough situation for hog producers in particular, but cattle as well, could have looked a lot worse without some strong domestic demand.
To round out our conversation this week, talk a little bit about trade concerns. Trade conversations are ongoing. It seems like this trade war with China is continuing to escalate. How does this all come back to our folks here that are producing corn, soybeans, cattle, hogs, all of those specialty crops that are impacted by this tariff and this trade war?
Yeah, so the volatility and the uncertainty just gets really tough to deal with. I think we had early in the week some news about potentially some discussions going on that might have talked about reducing tariffs on soybeans, and we saw soybean futures move up significantly and then retreat after that. It reminds me that folks should think hard about those periods of time where positive news comes out on the trade front as to whether or not that's an opportunity to use futures or other ways to lock in prices. Even in a case where it might look like it's a little red ink, you may be trying to minimize losses at this point using those risk management tools. Where we go from here, I don't think any of us know exactly the path forward. We know we're talking about trade assistance package that will provide some dollars out to crop producers as well as hog producers. Exactly how those come out, I think we're still waiting on all the details for that. Should be helpful, but you put those dollars back out there and maybe all else equal, we're going to keep the pressure on in terms of trying to negotiate tariffs lower in the case of China in particular. I still wonder if we don't end up with a bilateral unfolding with Mexico in the near term for us, which again, when we've talked about weakness in ham prices, if we got something done with Mexico, does that get us some recovery in ham prices that gives us a little lift on hog prices here in the latter part of 2018?
And there's been rumors that conversation with Mexico is ongoing, but nothing publicly has surfaced. Is the volatility and the uncertainty just as damaging as the announcements of the tariffs, just because there's so much left unknown, at least when it comes to moving markets and price-wise?
We just don't have a lot of experience under the kinds of events that have been unfolding. And so I don't think markets know how to react very well. And again, I'll say markets tend to react really quickly to the news of the day, and that can create, I think, issues. And I just worry for those that have made decisions that they thought were going to be really good decisions, little to find out that we have these tariffs in place now that are actually causing prices for our goods to be lower than otherwise would be the case. Those are things that you couldn't have predicted, and that's what makes it tough when you try to still look forward, going, when does this end? What's the effects if we purchase pork or we purchase beef for school lunch programs out of that trade assistance? What kind of lift do we get? trying to predict that and trying to be helpful as producers make decisions about pricing in this environment. There's just it's very tough, I think, to be helpful in that environment, and that uncertainty just I don't think is going to go away anytime soon.
Scott, as we look ahead to next week, what reports are we expecting, and what are we watching for out of those reports?
Yeah, so next Monday we're going to get monthly trade data. It will be the June trade data that we get. I wish we could get a little more information on what's been happening of late. I've been trying to watch that weekly export data, and not much is jumping out at me yet. We're going to finish the week with retail prices, and then also we'll get USDA's August WASDE report out. So that will give us the first indication of yields that are not trend according to USDA. So I've done some survey work on the yield side. So we'll see what their kind of first shot of corn and soybeans in the bin might look like given the weather that we faced so far in 2018.
I think the greatest part about this WASDE report is actually the pre-report estimates that lead up to it. I always like seeing where everybody comes in and all of the analysts on that side of things.
Yeah, I can tell you here in Missouri, I worry about our producers because we've got some pretty tough situations, especially in the northwest part of the state. Yet I think we're going to look at pretty good yields in many other parts of the country. So we may end up with producers that don't have much of a crop and also keep prices that are relatively low. So we'll wait and see how that plays out and how the analysts try to grapple with what they think the yield situation will be this year.
Scott, good to see you today. We look forward to our conversation next Friday.
Sounds great, Megan.
To have our weekly livestock market update delivered to your email box every Saturday morning, visit our website, brownfieldagnews.com. You can click subscribe. You can also submit questions and comments there as well. And for market updates twice daily, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Megan Rebner on Brownfield.